Okie dokie. So I've always wanted to learn about money and finance, the basics, not taking college courses or anything else like that because that costs money. So I just decided that I am going to learn with you guys about money, budgeting, finances, taxes, investments, 401ks, and all of that. So today, to start this off, we're going to learn about the essential topics of financial management. We'll discuss the importance of budgeting and how it helps you manage your finances, avoid overspending and saving for future goals. We'll learn about saving money and having an emergency fund to provide financial security during unexpected circumstances. We'll touch on investing as a way to grow your wealth over time. And we'll go over debt management, understanding credit scores and reports, effective retirement planning, the significance of insurance, the basics of taxes, and the importance of setting and achieving financial goals. So, all right, let's get into this. So creating a budget is like setting a roadmap for your financial journey. It starts with understanding how much money you have coming in and going out each month. By creating a plan for how much you spend your money, you can keep track of your income and expenses. I mean, that's just the basics. But this also ensures you're not spending more than you earn, which is my issue. You got to learn to live within your means. So budgeting is crucial because it empowers you to manage your finances effectively. And when you know exactly where your money's going, you're less likely to overspend. And this helps to avoid those moments where you wonder where all your money went. Instead, you can see every dollar's purpose and how it's contributing to your goals. Another great benefit to budgeting is it allows you to save, for vacations or a down payment on a house or car, or even if you just need extra money for emergencies and whatnot. Having a budget allows you to allocate money towards these goals. So budgeting is a daunting task. Everybody goes through it. What do I have to sacrifice? What do I need to do? But once you get the hang of it, it becomes a super valuable tool. You need to start by listing all your sources of income. And then you need to break down your expenses into categories like rent, groceries, utilities, etc. Don't forget to include categories for savings, vacations or car or whatever you want to save for. And for me, it's guitars. So in summary, budgeting is all about making a plan for your money. It helps you stay in control of your finances to avoid unnecessary debt, save for things that matter most to you. Taking the first step in budgeting right now, you'll help your future self. Now, I'm older. It took me a while to figure this out because I'm stubborn. I treat money like it'll never end. And when you don't make more money than you have going out and you don't have that expendable income, it'll catch up with you real quick. Anyways, savings. So we're going to talk about savings and emergency funds. Savings is essentially putting aside a portion of your income for future use. It's like paying yourself first before you spend on anything else. I've always heard that. You should always pay yourself before anything else. Take out the money that you want to set aside, and then everything else goes towards your bills. An emergency fund, on the other hand, is a specific kind of savings that's set aside strictly for unexpected expenses. Some people have credit cards for the emergency fund. It's a lot easier just to have that. Some people carry cash. Some people have their savings account or another checking account that they can split their monies into. So like surprise medical bills, urgent car repairs, sudden unemployment, you want to have something set aside just in case. It's not always going to happen. It's just not a realistic expectation. But if you start planning for that stuff, you'll have at least something. Having a strong habit of savings can really give you peace of mind knowing that you've got a cushion. Financial experts recommend setting aside 20% of your income. Again, you set aside what you think you need to set aside. I'm not a financial expert, so 20% of my income, that's just not going to happen. 5%, possible. But again, you have to determine how much you can afford to set aside. This can be done for short-term goals like vacations or long-term goals like buying a house. An emergency fund is a bit different. Its purpose is to cover you during those unforeseen circumstances, so you're not falling back on credit cards or loans. Ideally, you should aim to have 3 to 6 months worth of living expenses. In this day and age, 3 to 6 months isn't realistic whatsoever. A lot of people are living, paycheck to paycheck. Setting your budgets to realistic expectations and goals is the most important thing. Having both savings and an emergency fund is crucial. It not only helps you avoid debt, it also gives you a sense of financial security. Knowing you have money set aside allows you to handle life's curveballs with less stress. Financial peace of mind is priceless, and having savings and emergency funds can provide that. If you do have the money to invest and you find something that you want to try to invest in, do something like Acorns, where it's like $10 a week. That's what I do. And it can invest in a couple of different types of categories. You have a conservative category, you have an aggressive category. That's the one good way to start investing, is looking at something like one of those apps. So that way you can jump into it, but without the massive risk. So investing is different from just saving money, because the goal is to grow your wealth, not just keep it safe. So investing has been around for centuries. In ancient Rome, people invested in land and farms. During the Renaissance, Venetian merchants invested in shipping ventures. In the 17th century, you had the Dutch East India Company issuing the first shares of stock and laying the foundation for modern stock markets. So why is investing so important? Well, firstly, you don't need to be wealthy to invest. But like I said, if you start off something like, and I don't get paid for this, but if you start off on something like Acorns, you can increase your investment as time goes on, or you can stop it completely altogether. But things like that really help you, and you don't have to be rich to do it. Investing comes with risks. Stocks can go down as well as they go up. Real estate values fluctuate, so diversification is obviously the key. Spreading out your investments across different types of assets helps you to reduce the risk of losing everything if one investment doesn't perform. Investing is a vital part of financial management. It's all about making your money work for you over time, and it helps you achieve these big financial milestones. Debt management is all about understanding and controlling the debts you owe. Credit cards, student loans, personal loans, your mortgage. And the first step in effective debt management is to know exactly how much you owe and to whom. So listing all of your debts, including the amount owed, interest rates if you know them, and minimum monthly payments. And once you have a clearer picture, you need to prioritize which debts to tackle first. In my case, it's PG&E. Many experts suggest focusing on paying off high-interest debts first, like credit cards. This is often called the avalanche method, and it helps you save money on interest in the long run. Alternatively, the snowball method advises starting with the smallest debt to build momentum. You choose whatever method's best that fits your situation. Once you start getting all that stuff under control, your credit scores are going to go up. Credit scores and reports are two important tools to assess your financial health. Credit score ranges from 300 to 850. It's based on your credit history and is used by lenders to gauge how likely you are to repay your debts. There's 3 bureaus. The higher your credit, the more creditworthy you appear. A credit report is a detailed summary of your borrowing history. It includes information like loans, outstanding debts, or any later missed payments. Why are these numbers and reports crucial? Well, a credit score makes life much easier. You can qualify for loans and credit cards with better interest rates, saving you a lot of money in the long run. Imagine needing a loan to buy a car or a house. A high credit score means you'll pay less in interest, which can make a huge difference over time. Besides loans and credit cards, your credit score can impact other aspects of your life. Landlords often check credit scores to decide whether to rent to you. Some employers look at credit reports during the hiring process, which I feel is garbage. Unless your report comes back that you've stolen money or whatever else like that, just because you have a low credit score or mid credit score range, that's credit discrimination. It's essential to keep an eye on your credit health. Check your credit report regularly for any inaccuracies so that you can tackle it and write to the bureaus and write to the companies that have your information so that they can pull them off the credit reports so that it's accurate. And make sure you pay your bills on time. If you manage your credit wisely, you set yourself up for better financial opportunities in the future. Setting yourself up for the future also means retirement. And retirement planning is about getting ready for that time in your life when you're no longer working. It's important to start thinking about it early on so you can enjoy a comfortable and secure retirement. And one of the first steps is to set clear goals. What kind of lifestyle do you want? What do you plan to travel? You want to start a hobby or you just want to relax? If you know what your goals are, it will help you figure out how much money you'll need. There are several common retirement accounts to help you save: 401ks, IRAs, and pensions. A 401k is typically offered by employers and includes matching contributions, which is just free money. An IRA, which is an individual retirement account, is something you can set up independently, and it comes with tax advantages that can help your savings to grow faster. Pensions, though less common these days, provide guaranteed monthly income after you retire if you have them through your job. The key to successful retirement planning is to contribute regularly to these accounts, take advantage of any employer matches, and the earlier you start, the more time your money has to grow due to compound interest. Even small contributions add up over time. It's not about saving. It's also crucial to periodically review your investments to make sure they align with your risk tolerance and retirement goals. If you do proper planning, it ensures financial stability and independence in your later years. The goal is to have a nest egg that's going to support you, so you won't have to worry about money and you can fully enjoy your retirement. Take care of yourself and your money will take care of you. Insurance is a kind of risk management. It helps protect us from financial losses caused by unexpected events like illness, accidents, natural disasters, unless you're in California where all the companies are pulling out. When you purchase insurance, you pay a premium to an insurance company. In return, they promise to cover certain costs if something goes wrong. Different types of insurance for various needs: health, which covers medical and doctor visits, hospital stays, medications; car insurance, which covers damages to your vehicle and can help pay for repairs or replacements; home insurance protects your home and belongings from damage or theft. So having insurance is important because it ensures that you won't be left with massive bills after an unexpected event. Let's talk about taxes. So taxes can be a bit confusing, but once you understand some of the basics, you'll see how they fit into your financial picture. So income tax is what most people think of first. It's the tax taken from your paycheck and added to the government, or paid to the government. Property tax is what homeowners pay based on the value of their property. Sales tax is something we pay on goods and services we buy every day, and knowing how these taxes work helps you plan your finances better. Understanding income tax can help you figure out how much take-home pay you'll have each month. Property taxes can influence your decision when buying a home, and being aware of sales tax can help you manage your spending. Tax planning is not for just the wealthy. Good tax planning can help you save money, like certain retirement accounts. The 401ks and IRAs offer tax advantages. Contributing to these can lower your taxable income. Also, knowing which expenses are tax deductible, like student loan interest, mortgage interest, things like that, can reduce your taxable income even more. Filing your taxes correctly and on time is crucial too, as it helps avoid penalties and ensures you get any refunds you're entitled to. The more that you understand and plan for taxes, it helps you keep more of your money. So when we're talking about financial goals, you really need clear, actionable objectives set for your future finances. These could be anything from buying a house and paying off debt, saving for a child's education, or planning a vacation. The idea here is to give yourself a clear roadmap, which makes achieving financial success a more structured and manageable process. Setting financial goals starts with identifying what's important to you. Home ownership may be a priority, and if so, you'll want to focus on saving for a down payment and understanding mortgage options and considering how this fits into your overall financial picture. Another common goal is paying off existing debt like credit cards or student loans, or getting rid of high-interest debt. Getting rid of high-interest debt frees up a lot of money to help you save and invest in other areas. Once you've identified your goals, the next step is to prioritize them. Not all goals will have the same level of urgency or importance. While saving for retirement is critical, paying off high-interest debt might take precedence just because of the financial burden it imposes. By ranking your goals, you can focus your efforts and resources more effectively. Another key aspect is breaking down larger goals into smaller, more manageable tasks. If your aim is to save $20,000 for a house, consider how much you can realistically set aside. By tackling smaller chunks, you can make consistent progress without feeling overwhelmed. Keeping track of your progress is also important, so you need to regularly review your goals and adjust your plans as needed. Life changes, and your financial priorities also might change. So being flexible allows you to adapt to new circumstances without losing sight of the big picture. Also, share your goals and progress with someone you trust. Having someone as an accountability partner can keep you motivated and offer a fresh perspective when needed. All right, that's all I got for today. Thanks for listening. If you like it, hit that subscribe button for us. If you don't like it, that's okay too. Other than that, have a great day.